Would you pay $10,000 for land you can't touch? It sounds absurd, but in the metaverse, it's happening every single day. This isn't just a video game. It's an economic frontier, potentially worth trillions. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're diving into the economics of the metaverse. We'll explore how virtual markets are creating real-world value, turning pixels into property and gameplay into gainful employment. Let's start by defining our terms. The metaverse is an interconnected web of 3D virtual worlds where you can work, play, socialize, and shop. Think of it as the next evolution of the Internet, a more immersive spatial version where you don't just browse content, you exist within it. Projections from major financial institutions estimate its potential contribution to global GDP could reach into the trillions within the next decade. This isn't a niche hobby, it's a new economic paradigm. This new world is already bleeding into our own through things like NFTs, which act as digital deeds of ownership, and branded virtual spaces from giants like Nike and Samsung. The line between the physical and digital economy is blurring faster than ever. This brings us back to that provocative question. Would you pay $10,000 for land you can't touch? By the end of this video, you'll understand exactly why someone would. To understand the metaverse economy, you must first understand its virtual markets. These aren't just features within a game. They are complex economic ecosystems. Worlds like Decentraland and Roblox operate like miniature digital nations, complete with their own currencies, systems of trade, and principles of scarcity. Just like in the real world, the fundamental laws of supply and demand are in full effect. A key driver of value in these markets is digital scarcity. Developers can create a limited number of items, plots of land, or unique cosmetic skins. When millions of users want these limited assets, their value skyrockets. This is no different from the market for rare art or beachfront property. It's scarcity, whether natural or artificially designed, that creates monetary value. But why do people desire these digital assets in the first place? It comes down to the psychology of ownership. Humans have an innate need for self-expression, status, and exclusivity. Owning a rare virtual item or a prime piece of digital land provides the same social signals as driving a luxury car or wearing designer clothes in the real world. It's about identity and community belonging. Case studies from platforms like Roblox, where creators earn millions from selling virtual goods, prove that this desire translates into a powerful multi-billion-dollar market. The technological backbone that gives these virtual markets legitimacy is the blockchain. Blockchain acts as a universal, decentralized trust mechanism. It's a public ledger that authenticates ownership and, crucially, prevents duplication or fraud. You can just copy-paste a valuable digital asset because the blockchain verifies its originality and who holds the title. This is where non-fungible tokens, or NFTs, come in. An NFT is a unique digital certificate of ownership recorded on the blockchain. You can think of it as the digital equivalent of a property deed or a car title. It's an unforgivable proof that you, and only you, own a specific digital item, be it a piece of art, a plot of virtual land, or a special in-game sword. This system has enabled the rise of vibrant secondary markets. Platforms like OpenSea function as digital auction houses where users can buy, sell, and trade these NFT-backed assets freely. This transforms abstract digital items into liquid, tradable assets. Blockchain and NFTs are the catalysts converting virtual creativity into tangible digital wealth, giving the metaverse economy a foundation of trust and transactional integrity. The metaverse isn't just about assets, it's also about labor. As these digital economies expand, they are creating entirely new job categories and income streams, humanizing the virtual world with real work and real pay. We're seeing the rise of virtual architects who design buildings in the sandbox, digital fashion designers creating clothing for avatars, and event managers who organize virtual concerts and conferences. The play-to-earn model, popularized by games like Axie Infinity, allows players to earn cryptocurrency rewards through gameplay, which they can then exchange for real-world money. This has evolved into a broader create-to-earn economy, where artists, developers, and community builders are compensated for their contributions to the virtual world. For many, especially in developing nations, this has become a primary source of income. Furthermore, the metaverse is becoming a new frontier for remote work. Companies are building virtual office campuses where employees can collaborate as avatars, offering a more immersive and interactive alternative to video calls. The metaverse allows for the direct monetization of time, creativity, and skill in a purely digital realm, connecting individual effort directly to macroeconomic output in a way we've never seen before. Let us take a closer look at one of the most fascinating and controversial assets in the metaverse, virtual land. Why are people and companies spending millions on digital real estate? Again, it comes down to designed scarcity. Platforms like the Sandbox and Otherside have a fixed map with a limited number of land parcels. This finiteness is a deliberate economic choice to ensure the land holds and appreciates in value. The valuation of this digital property mirrors real-world real estate metrics. Location is everything. A plot of land near a popular virtual venue, a major brand's headquarters, or a high-traffic social hub is significantly more valuable. Other factors include size, development, potential for experiences, and the prestige of the surrounding neighborhood. People are making a speculative bet that they are buying a piece of the next Manhattan, a future digital metropolis where millions will gather. They're not just buying pixels, they're buying future foot traffic, advertising space, and social relevance. Every functioning economy needs a financial system, and the metaverse is no different. Most major metaverse platforms have their own native in-world currencies, which are typically cryptocurrencies. For example, Decentraland uses Mana, and the Sandbox uses Sand. These tokens are used to buy land, assets, and services within their respective ecosystems. They can be traded on external crypto exchanges, connecting the virtual economy directly to the broader financial world. These digital currencies are subject to the same economic forces as traditional money, including inflation and speculation. The value of Mana or Sand can fluctuate wildly based on platform user growth, new partnerships, and overall market sentiment. To bridge this volatility, stablecoin cryptocurrencies pegged to a stable asset like the US dollar increasingly being used for transactions, providing more predictable commerce. Looking ahead, we're seeing the beginnings of metaverse banking and decentralized finance, or DeFi. Users can already lend their virtual land as collateral for loans or stake their metaverse tokens to earn interest. This represents a fusion of gaming, social media, and high finance, creating a sophisticated financial layer on top of these virtual worlds. Consumer behavior in the metaverse is a goldmine for marketers and economists alike. Global brands are flocking to these platforms not just to sell virtual goods, but to build deeper relationships with consumers. Nike has Nikeland on Roblox, Gucci is selling digital bags for more than their physical counterparts, and Coca-Cola has launched virtual collectibles. These companies understand that in the metaverse, brand presence is about participation, not just advertising. The principles of behavioral economics are on full display. Consumption is driven by the desire for identity, status, and community. A user buys a virtual Nike sneaker for their avatar for the same reason they buy one in real life, to signal affiliation and express personal style. Advertising models are also evolving. Instead of banner ads, brands host immersive events, create branded mini-games, or build permanent virtual flagships where users can interact with their products in a fun, engaging way. In these digital spaces, the key insight is that emotional immersion and authentic engagement are far more powerful than simple exposure. Of course, with great opportunity comes significant risk. We must approach the metaverse economy with a healthy dose of realism. The markets for virtual assets are incredibly volatile and speculative. The value of your digital land or NFT collection could plummet overnight. Fraud is also rampant, with scams targeting inexperienced users. Beyond financial risk, there are profound ethical dilemmas. Privacy is a major concern. Virtual worlds collect vast amounts of data on user behavior. Digital inequality is another challenge. Will the metaverse become a playground for the wealthy, creating a new digital divide between those who can afford to participate and those who cannot? And as these economies grow, questions of regulation are becoming urgent. How should virtual income be taxed? How do we apply property and contract law in a borderless digital jurisdiction? Balancing innovation with protection is the critical challenge for policymakers. So, what does the future hold for the metaverse economy? We are moving towards a deeper integration of technologies like artificial intelligence and the Internet of Things (IoT). Imagine AI-driven characters populating virtual worlds, creating dynamic content and economic activity. Or consider the phygital concept, where physical objects are linked to digital twins in the metaverse, blurring the lines between ownership in the real and virtual worlds. Future trends may include tokenized labor, where your work contract is an NFT, or entire virtual cities run by AI-based economic models. The possibilities are as vast as our collective imagination. This raises a new question. When our digital lives have their own economies, what will be the most valuable resource of all? In conclusion, the metaverse economy represents what some are calling the next phase of capitalism. It's a frontier built not on physical resources, but on technology, creativity, and community. At its core, it demonstrates a timeless economic principle. Value is a product of scarcity and human desire. Whether it's a rare shell, a bar of gold, or a plot of digital land, if people believe it has value, it does. The tools and platforms may be new, but the underlying human psychology is as old as civilization itself. We've covered a lot today, from virtual markets to digital labor. Now I want to turn the question over to you. How do you define value in this increasingly digital world? Let us know in the comments below. And if you found this breakdown valuable, please hit that like button, subscribe to Economy Unpacked Daily, and ring the notification bell so you never miss an update on the forces shaping our world. Thanks for watching.